Hello and welcome to PropNext, the property podcast about all things related to the future of real estate. I'm delighted that you've joined me today. My name is Gavin Morgan, your host. If you'd like to know a little bit more about me, please check out www.propnext.com. That's propnx.com. Or drop me a line if you'd like to chat privately on gavinrmorgan@propnext.com. That's GAVINRMORGAN @propnext.com. David Raven, welcome and thank you very much for joining us today on PropNext.
Yeah, morning, Gav. Really good to catch up again.
No, absolutely, and delighted. I hope you don't mind me mentioning that you're dialing in from holiday space at the moment. So it's thanks for making the time to talk to us from your summer retreat. Lovely, and David, obviously you and I have known one another for a long while, and sort of initially became acquainted in our corporate career, or the parts of our corporate career that we spent out in Asia. But obviously, as it relates to today's conversation, a super interesting topic for me. You're talking about opportunities in a changing investment environment. Maybe just give us a little bit of background on your current role and what you're doing before we kick off.
Yeah, well, thanks for having me. So my background, you and I obviously intersected at JLL in Hong Kong. I was at JLL, which is an amazing business, for 16 years, starting in London, primarily focused on the retail sector, and then moved out to Hong Kong in 1999. And it was an amazing experience for me to get a more global view through being in one of the world's leading kind of global hotspots. And so I was out with you guys in Hong Kong, but doing a sort of more broader Asia capital markets role for 4 years. And then I moved back to London onto the, still on the investor advisor side, but working for an investment management platform called Infrared Capital Partners, which again was a great experience and a great kind of movement in my career, and something I desperately wanted to do. I was with the partnership for 4 years, and then at the back end of 2019, we started a business called Re-Aim, and we're focused on data-led market research, investment strategies with an investor client base that we effectively promote an investment strategy, and but the investor themselves retains the investment discretion.
Okay. And obviously, David is one of the senior leaders in that business, or founding senior leaders. Just tell us a little bit about what types of returns you're seeking in a business like that, or for investors in today's environment.
Well, I think it's quite an interesting question in the sense that we are not like a closed-ended opportunity fund that has very preset, determined return hurdles and the economics that flow from that. What we try to do is align ourselves with our investors' objectives. And as you know, the sort of ecosystem of the investor community has changed hugely in the last decade. And you've got some investors that are looking to invest from a sort of generational viewpoint, and to try and fit a strategy or fit a return hurdle that might be more appropriate for an opportunity fund into that type of capital partner isn't right. So we broadly look at what our investor base is looking to achieve, and align ourselves with that return hurdle. So, for example, if we're working with say Hong Kong private families who are looking to deploy capital in very low risk and for a sort of multi-generational purpose, their return hurdle is going to be somewhat different to working with private equity funds where we act as effectively operating partner, where the return hurdles are going to be much higher, and importantly, the business plan period is going to be much shorter. So we don't have it. It's not an easy answer to that question in terms of saying it's a 15% IRR return over a 5-year period. It really does depend on the constituency of the investor community that we work with, which is varied.
Okay, so it's case by case, and you try and match returns to the audience that you're hoping to deploy for or with. Is that, I'm hearing that correctly? Yep.
Yeah, that's correct. And like I say, what we do is we, as opposed to just saying to the investors, what returns do you want? These are assets these are opportunities that meet that return hurdle. We effectively come up with investment strategies where we think there's kind of positive tailwinds to either a sector or a specific location, and identify what the return hurdle is, and then work out which of our investor relationships such a strategy would best be served by that return hurdle.
And David, you and I chatted a few times on this over the last couple of weeks. Not necessarily a great thing, but I think the sort of looking ahead, certainly the next 18 months, I think it's pretty fascinating with what's happening with rate rises and the impact that's going to have on all different types of investments. We had a chat on this show actually last week with a gentleman talking about equities versus real estate from that perspective. How much do you think what you're trying to do is going to be challenged by future rate rises? And I mean, have you any thoughts on how you're planning to counter that?
Yeah, I mean, it's fascinating times, and it is actually something that we did predict at least 2 years ago, when you saw the central banks essentially printing money via their various kind of asset purchase schemes. We predicted that the first stage would be asset price inflation across the board. And real estate, certainly the hotspots of real estate, have really benefited from the weight of capital that's been focused on those sectors. But we're in a very different place now with interest rates going up. We see it as a likely opportunity for some buying. We think there will be a significant repricing of almost all assets, probably over the next 3 to 6 months. I don't necessarily foresee a crash in asset values, but I do think there will be repricing because an awful lot of the market, number one, has to kind of compare returns of real estate to risk-free rates, but also there will be some refinancing risk that comes through because of the timing of debt maturities that are coming through the system as well. It's not going to be a comfortable place if you're highly levered and you have to go through a refinance over the next 6 months. That being said, that there is still an awful lot of capital that is looking to be deployed in the sector. And I think it will be, interesting times. I think that the challenge is to identify which sectors of the market and which assets within those sectors are likely to be best protected from rising interest rate environments at a time when we've got rising inflation and pretty low GDP growth forecast for most Western economies. So it's not going to be an easy world to navigate. And there's lots of other issues as well, as opposed to just interest rate rising. You've still got the backdrop of the supply chain disruption and the cost effects of energy prices on things like construction costs. And if you're looking to do any development, it's very challenging to get the construction costs to stack up at the moment.
Yeah, and added to that, and David, I think you alluded to some of the results of this as well, but obviously geopolitics and a more nationalistically thinking world as well. I mean, adds to a cocktail of things that do make the future a lot more unpredictable than it's looked for quite some time.
I think that's right. And one of the things that when we began Re-Aim, we looked at was the sort of global megatrends. And we've effectively said that there's 6 megatrends, and they're almost like dials on the cockpit. They dial up and dial down at different kind of cycles of the economy. And the megatrend that seems to be very dominant at the moment is geopolitical risk, particularly with the Russia-Ukraine situation, and the consequences of that, which the various bad actors in that scenario are all too well aware of the effects it's having on global economies, and then the consequences of that on anyone making investment decisions is very real.
Yeah, no, indeed. It will be helpful when it all smooths, but it doesn't look like that's going to happen in the short term. David, I wanted to turn around to I think a question that I'd originally asked you, and then you'd come back to me and asked me about a sustainability related point. I mean, as you know, I like to have sustainability on the agenda in these conversations. You'd asked me about embedded carbon versus new build green buildings. For the listeners on the podcast, could we maybe kick off? Could you just explain the difference between the two things, please?
Well, I think the sustainability agenda has obviously sort of grown hugely, and it's an important factor for citizens as well as investors to take into account. The built environment, I think some people have the percentage of carbon emissions as being 60% of global carbon emissions is a result of essentially what the ecosystem that you and I work in. I personally do not feel that the embedded carbon within buildings is being correctly or correctly articulated or correctly researched sufficiently. And I think that the answer of knocking down reasonable buildings to be replaced with fine, great green buildings is one strategy that is being deployed. But I do wonder whether whether it is the right long-term thing to be undertaking.
Yeah, David, I agree completely on that. I mean, there's got to be a better way of repurposing existing assets rather than just tearing them down and rebuilding, but quite a big topic there.
It is, and I don't feel sufficiently educated enough to comment on that. And a lot of the professionals that I've spoken to that are still maintain that a lot of buildings are the life cycle of buildings is different, and a lot of the time on the way that in which carbon is measured at the moment, the answer still comes down to knocking buildings down and building them again, which intuitively to me doesn't seem the right thing to do. But like I say, I'm not an expert in that field, but I think it is a discussion that everyone should be having.
And David, as an investor, can I just jump? So, as an investor, would you? And I hear clearly what you just said about expertise, but would you favor well repurposed, sustainable existing assets over a new build, or is it too early for you to feel that you would put or influence investors in that direction?
Well, I think there's two elements. One is you've got to look at the financial returns, and if you isolate the sort of the financial returns and just look through that lens to begin with, there is definitely a premium being paid both by occupiers and as a result investors for occupying green buildings. So it's an easy decision for a corporate to take for their stakeholders to say that they are locating within a green building, and premium rents are being paid for buildings that have all the good well-being characteristics, which is fine. And again, if you want to be future-proofed as an investor, you buy the most green, sustainable building that you can in the best location that you can because ultimately that will attract the best occupier types and the most premium rent. I also think there's a very interesting investment case for buying good, essentially building frames and repurposing them and ensuring that you can create sustainable buildings or better buildings that might not be the very, very top rated assets from a sustainability perspective, but they meet the targets that are in place, and you can try and achieve the same result in terms of attracting those corporates that do have sustainability agendas and sustainability targets to hit, but you're not going through the process of removing perfectly fine structures and having to rebuild from ground up. So I think there is a big movement and good profitability in effectively buying brown buildings and turning them into green buildings to simplify it.
No, like absolutely, David. And yeah, it's certainly in some of the conversations that I've had with other investors. I mean, I'm hearing a lot of interest. Certainly amongst the funds management world around putting together funds that are focused on doing exactly what you just talked about. I mean, I suspect we're going to see a lot of activity focused on that space, and I think it feels like a really good fit from a purpose point of view for what the world is trying to achieve at the moment as well.
Yeah, I totally agree with that. I also think that from an investor's perspective, if you're buying green buildings, there is a supply demand imbalance, and because of the construction cost inflation that's been witnessed, that supply imbalance isn't going to be resolved anytime soon. So I think a case can be made for buying the really good green buildings, and it should be that buying brown buildings and turning them to green buildings is a profitable exercise, but the caution is around construction costs in delivering those at the moment versus entry prices.
Yeah. David, that is a really interesting tangent that I'm not going to take us on, but I think there's a huge onus on suppliers of sustainable materials to make them remotely comparable with the cost of materials that haven't been sustainably sourced. There seems still to be huge premiums in that market, and that doesn't fully support. And I'm sure it's an absolute cost issue rather than a profit exercise. But there still seems to be a lot of road to travel on that too. David, just on the return side of things, new technology that's driving sustainability in terms of investment. Are you seeing a lot of green premium or brown discount yet? And just when you're talking about that, could you comment on what you think it's going to be like in the future versus what you're seeing at the moment?
I think you're certainly seeing a green premium being paid for assets. I don't necessarily think that there is a sufficient brown discount that is being witnessed in the market yet. But actually, I think it will come. So I would be apprehensive about buying non-green buildings at the same kind of price point as they are being marketed at the moment. I think that there does need to be further discount for buildings that are not that they're no longer fit for purpose, and the simple maths of converting them. The economics don't add up in many cases yet. And I think that the obvious place that the pricing will have to move is that buildings that are not meeting minimum sustainability criteria will have to become cheaper. So in answer to your question, I expect poorer buildings from a sustainability perspective to become cheaper in the medium term.
Yeah, and that is a really interesting space. We've alluded to that a few times. I think the corporate world at the moment is really playing a part and starting to drive the market in that direction. There are many major corporations out there who now will not occupy assets unless they meet a certain criteria against, many of the various regulatory standards that are out there at the moment that define how green or sustainable a building really is. I think as that grows, it's going to really put pressure in a good way on what you've just talked about. And in turn, David, that will hopefully then make it easier for organizations like yours to get your hands on assets like that and take them back to where they should be on the sustainability ratings with, good quality, thoughtful refurbishments with the environment in mind, rather than kind of knock down and redevelopment. So it's interesting, even listening to what you're saying here, how opportunity seems to be appearing, or cracks are appearing, that will help us get to where we need to be around all of this. David,
I think that's...
Go ahead.
Sorry, Gavin.
Go ahead. Go ahead, please.
I think that's true. And again, you'll have more insight into this from an occupier perspective. I hope it to be true, but I just wonder if the corporate board table, I just wonder how loud the sustainability voice will be if we enter a period of global recession or a real global slowdown in the economy. Or will the voice of the financial director saying we can't afford, or we can't justify in financial terms, to pay those very, very premium prices because green buildings are more expensive to occupy, we will kind of, as a corporate, decide to maybe lower our expectations on sustainability versus and benefit from a rental perspective. And I would be interested to get your view on whether you think that the sustainability challenge is sufficiently embedded within corporate decision making, that even in the face of a recession, the decision makers will still err on that side of the argument as opposed to the cost reduction exercise of the argument.
Yeah, look, David, thanks. And the answer to that is I don't think it's sufficiently embedded at the moment, but I do think a lot of progress has been made. A cheesy line that I've used on this podcast before as well, which I've always felt. And when I look back at the many projects that I've been involved in over the last decade or so, including many that have achieved top sustainability rankings in their respective markets, many of the features that the owners have been required to put into the buildings haven't actually been practically applicable to the locations that the buildings are in. So I think that's changing. I think buildings are green now, or becoming more appropriately green or sustainable for the locations that they're in, i.e. they include features that actually work to help the environment for the location that the building's in. But I do think the green meaning dollars piece, and what really drives owners, what really makes owners think, is the requirements of the organizations that they want to house in their assets. And there is much more pressure there now. It does now mean dollars, and I do think that I agree with you. There may be some blips as we go through if we go through a troubled time with the economy, but I do think the momentum is there, and I expect that momentum to grow. And I think the real estate industry will rise to the challenge of creatively addressing the cost issues and the need to circumvent economic issues as well, to make sure that there is sustained progress in this space, because there is a financial advantage to doing that, and I think it's now embedded enough where it won't go away even in a weaker economy, but we'll see. David, we probably need to wrap things up. This has been a really enjoyable conversation, and I wanted to end in one question that I think you're certainly best placed to answer here. Are we witnessing a mini boom moving forward in the immediate term as investors see real estate as a hedge to inflation?
Oh, good question. I mean, there's certainly an awful lot of narrative around the historic trend of real estate being a good hedge to inflation. I think the caution on that is twofold. One is that the amount of capital that is allocated to real estate or alternatives in general is going to be influenced by the fall in all of the other asset classes. So there won't quite be as much, not appetite, as much of a push factor from the institutional investment community to put to effectively diversify their portfolio further to alternatives because of the weighting issues of their equities and bond portfolios that have probably fallen in value. So that's one impact on that. I also think that inflation with limited GDP growth is going to make it difficult for the real estate sector to become as good an inflation hedge across the board as it perhaps has been more historically. And that said, I think there are exceptions to that. And I think you've got to pick the sectors where it's much easier to market rent or even more than rent, your income streams, than typically long-term leases with 5-year rent reviews have enabled investors to do previously. So we're looking significantly at occupational strategies where you can mark to market quickly, and that is things like self-storage. It is sectors such as flexible office leasing, WeWork style offices, but it is a difficult it's a difficult backdrop when you've got inflation without GDP growth. Do I think we'll have a mini boom? There's not that many investors that are seeing the next 3 years being as positive as the last 3. I think it's going to be case by case and making sure that you very carefully pick which sectors to focus on and make sure you've done your research, picking the sectors that have got structural tailwinds and avoiding the often easy thing to fall into, which is the latest kind of gimmicky fad that might attract a lot of capital for the short term, but isn't necessarily a long-term good bet. So I don't necessarily think we'll see a mini boom. I think you will see a flight to quality, and I think the very best assets and best strategies will perform well. But I think it's going to be a very uneven picture across the different asset classes and assets within individual asset classes as well.
So it sounds a little bit like, as we wrap up, opportunity from uncertainty is the watch catchphrase looking ahead. And David, it just leaves it for me to thank you very much for joining us today on PropNex. I mean, certainly a super conversation. And David Raven, thank you very much for being on the show. We'll have you on again soon, I hope. Thank you.
Thanks for having me, Gavin.
So that's a wrap for today's show. I'd like to thank you very much for tuning in to listen today, and hope to welcome you back to hear some of our future shows. As I mentioned earlier, if you'd like to learn a little bit more about me, look at www.propnex.com. That's PROPNX.com. Or drop me a line on gavinrmorgan@propnex.com. That's GAVINRMORGAN@propnex.com. I hope to hear from you soon, and thank you very much again for tuning in today. All the very best.